Dundas Partners, based in Edinburgh, and we started in 2010, so we're almost 10 years old. We have a very simple business. We focus on one thing only. We invest for capital and dividend growth, and that is the investment strategy that we manage. Our firm is 11 people, 8 of which are partners, and we try and keep the business as simple as possible. We try and make sure that we're completely aligned with all of our clients, so we invest in the strategy alongside our clients, and we are completely independent.
Our investment process, we call it sifting. So the reason we call it sifting is to differentiate it from a thing called screening. Screening is saying in advance, I'm looking for, let's say, medium-sized growth companies, which is fine. And if you go and look for them, you'll find them. You'll miss a lot. So what we do is sift through the entire universe, over 3,000 companies that we could invest in, and we invest in about 70. So we're picking 2% of them. But what we mean by sifting is by looking at everything, we learn which industries are stronger, which companies are stronger, which are weaker. We understand the financial records of all of them. And most importantly, you learn so much from that which you discard, because very often the strongest companies are replacing the businesses of the other ones, but they are intimately connected with each other. And so what we want to understand is all of those connections to make sure the portfolio is invested in a portfolio of great companies with long-run growth potential. We try and not be biased in advance. Rather than deciding what will be good, we sift through everything available to discover that which is good. And that's the key to our approach. It is the single most important thing to long-term investment returns. And don't take my word for it. There has been a series of studies. The one that we would highlight was a study done for the world's biggest fund, the Sovereign Wealth Fund of the Norwegian government. And they commissioned a study from a company called MSCI in 2016 and asked them what drives global markets, because we want to align our fund with what's driving those markets. And MSCI came back and said, as far as equities are concerned, for periods more than 5 years, for investment horizon of more than 5 years, dividend growth and dividend yield are by far the biggest factors. Now, I said 5 years. If you're investing for a shorter period, you are subject to the slings and arrows of outrageous fortune of valuation. You're subject to the coronavirus, which is a big issue today, or Brexit last year. These are big and important things, and they have an enormous impact in the short term. But as time passes, what has the biggest impact in the long run is the growth of businesses. The businesses that make the camera I'm speaking into just now, the businesses that make the pen in my pocket, the businesses that make the computer I work on. And as time passes and they make great products that people buy, that is much less volatile than these political and other stories. And as they grow and generate cash, once they've invested in the business for the future, they can pay a dividend. And we want to invest in the companies with the best prospects for rising dividends, because our own experience and the academic research tells us that is a sure and steady path to long-run investment success. So that's why we focus on dividends.